Hey everyone, welcome to the Atlanta Startup Podcast. My name is William Leonard, your host for today, and I've got Andrew Bate, who is the CEO of Safely.com, joining me. Andrew, welcome to the podcast.
Oh, thank you, William. Happy to be here.
Yeah, well, Safely is an Atlanta-based insurtech and guest screening solution for the vacation and short-term rental market. And we'll dive into what that practically means a little bit later in the conversation. But we have really a lot to unpack during our time today, Andrew. So I want to go back a bit and talk about some of the experiences that you had, right? You started out, you did some early things in management consulting. You were an entrepreneur before building Safely. You worked in a couple strategy roles. Talk to us about your journey into tech and entrepreneurship and ultimately what led you to starting Safely back in 2013.
Sure. Wow, that's a loaded question, but I've always been entrepreneurial. My parents thought it was really weird when I thought I'd be pre-med, like every freshman is pre-med, especially at Emory. Like they didn't understand it, but what I what I thought is in my hometown, the most successful person was the doctor. And because I ran a good business and I want to run a good business. So I think I should be a doctor and definitely organic chemistry. I did fine, but it was not nearly as fun as accounting. And so that's where I knew like business is where I need to be. And I'm a founder of some sorts. In 1998, as a student at Emory, I started a company called lunches.net. We'd send out an email every morning listing the local lunch specials. So you had a field guide of where to eat. And remember, this is 1998. This is before Google started. Like this was innovative at the time. I know it's now like it's spam email, but at the time this was unique. 2001 happened. There's a downturn. We took on some investment from an angel investor in Atlanta, but that didn't kick off. But then I started the masters swim team, the adult swim team with Swim Atlanta at the Sugarloaf Pool, and so ran that and started from 0 people, and you ended up being a good group of swimmers who are still going today. That was the next thing I started, and then realized I wanted to get a little bit more business experience, and I went to McKinsey, the management consulting firm in the travel practice here in Atlanta, and got a great 2.5 years of working with big companies, which I think was really valuable because big companies are who we want to partner with as founders and who we want to be like in certain ways, who we're competing with in other ways was when we start a company. So really great experience to get kind of rapid exposure to big companies, but also knew that unless I wanted to be a partner at a consulting firm or a professional services firm, which I don't, that I needed to like take what I learned, but then go back and like build from there. So I went to business school, spent 2 years trying to figure out what I wanted to do next, but interviewed hundreds of homeowners to see how can you have a second home but leave it empty and not monetize your family's most valuable or second most valuable asset. How can you do that? And so I just learned about just some of the challenges in the short-term rental space, and that's how I got into this.
Yeah, you started off with customer discovery before you even really had an idea. That's awesome.
Yeah, and it changed a lot, and really I talked to so many smart people, and just pressure tested. Like there's nothing secret. I talked to anyone. It was
Yep.
probably a little annoying, but I yeah, I just wanted to learn.
Right. And so let's keep that going a bit. You're right. You started talking to homeowners who had these second homes. Oftentimes they sat vacant and idle when they weren't there on vacation, probably, underinsured maybe as well. And so you talked to them, you got feedback. What was the moment for you where you said, all right, I need to go out and solve this problem and ultimately build a company around this problem?
Yeah, I mean certainly I was overconfident, like every founder has to be. Otherwise, like if you knew how hard it would be, you never would do it. And so I was like, this will take 3 months. I'm ready to launch. Like everything's fine. And so it was it was understanding there's kind of a connection that happened as I was interviewing these homeowners. So I'd ask them, "Do you rent your house when you're not there?" And they said, "No, of course not. Who would do that? That's silly." But then I would ask a little further and ask, "Well, what happens when you're not there? Does anyone stay there?" And they're like, "Oh, well, friends of friends can stay, and then people from church can come." And I list something in my school's alumni magazine, so I'm fine with alums from my university coming. And then I donate a week to my kids' little league auction. So these are random people coming into my house. So they're not optimizing for money, they're optimizing for trust or comfort or safety. And so as I went a little further, I was like, we can reproduce this feeling of trust by answering the question of who's staying in my house and what happens when something goes wrong. If we can answer those questions, well, all of a sudden this asset that's sitting empty can be monetized and someone can pay the carrying cost for this very nice second home that they bought.
Mhm.
And that was the like, it's like, wait, this can be done. It's not just impossible for these homes to be rented. Under certain conditions, which I think we can create, this house can be rented.
Right. And so you found that they were really over indexing on trust and optimizing for these trust networks that they had with close friends, church fellow churchgoers, and family members. But obviously, there's a huge market outside of those connections. And so tell us a little bit more about Safely today in its current state, 2023, and how you practically serve this market and serve your clients.
Yeah, so today, safely, we're 40 people. We're on the third floor of the ATDC or Synergy building at Fifth and Spring Streets, and about half of our team is in Atlanta, half is outside of Atlanta. We just opened an Amsterdam office, so we have two people over there, and we're working on our European, UK, and Swiss expansion. Um, we you fast forwarding, we've insured about 3.2 million nights so far. 700,000 more nights are on the books. Where we have an insurance policy that protects homes with no deductible up to $1 million. It works in every single state and territory in the U.S. And again, we're shooting for September 1st to have it working in the EU. And so that's who we are today.
I love it. I love it. And so you're serving all short-term rental and vacation homes, or is there a certain segment that you all have on the roadmap and aren't targeting yet? Tell us a little bit more about who's right to be using Safely's products.
Yeah, I think like with anything in insurance, we love average customers.
Mm,
Average customers, like average price point, average length of stay, everything average, claims, then they're predictable. We know what to do with that. So our typical reservation is 5 nights long, a mix between a long weekend and a week. And our average home rental price is around $450. So it feels like a lot of money, but at the same time, it's 2 bedrooms, 3 bedrooms, like per bedroom compared to a hotel. These are still very well priced.
mhm.
And where so our focus is on vacation destinations at the lake, the ocean, in the mountains. That's it. A little bit less on the urban, only because in the last 2.5 years that's been a little slower due to COVID. People were getting out of the cities versus going into the cities. And we do stay away from some luxury homes. It's not that we can't put together the right policy, but luxury homes have fancy things. Like they have carpets that cost $20,000 and tables that are $10,000. And like these are legitimate expenses if someone ruins them, but it's hard to create a premium that can really, really recover that spend.
Right.
Another area we're starting to figure out are shared rooms within a home. So, like, if the owner's there at the same time a guest is there, like, where do you draw personal liability versus commercial liability? It's hard to do that, but we're working on you getting those lines drawn really well so we can service the shared home as well. But all this is short-term rentals. There's a vibrant ecosystem for annual rentals, multifamily units. That's been taken care of before, but that infrastructure needs to come to the short-term rental world, and it's not there with the sophistication uh, that's there in the long-term rentals.
you talk about this hyper focus on the short term rental market. Before Safely came into the space, how was this problem of short term rental insurance and guest screening practically being solved? It sounds like it was solved in a very piecemealed, one off fashion. Tell us more about how it was being solved before and where you really saw the opportunity for innovation.
Yeah, the way you would insure your home, and you still can, it's the typical way of insuring your home if you're going to rent it and create a business in your home, is you need a commercial rider on your homeowner's policy. So you'll get your homeowner's policy from State Farm, from Lemonade, whomever. But if you're going to run a business, you need to get that commercial rider, or you're going to rent it, which is a business. And the commercial rider will work well. It's written by a good insurance policy, but it's going to cover all 365 days of the year, and it's going to have a high deductible because anytime you buy insurance, the higher the deductible, the less your premium is, and you figure out kind of where's your price point, and you make that work. Is it $1,500 deductible? And and that works. That said, agents who aren't as educated about that, you tell them that you're renting your home out, and they say, "Well, I'm sorry, William, we're going to drop your coverage because this isn't written for an Airbnb." It's like, no, but help me find a solution. They'll say, "I'm sorry, we're going to drop you," and then you're like, "Well, okay, then you can't insure my cars either and my other things." And so it's not an easy process. Buying insurance is never easy, but it's especially difficult in this kind of new use case. Where our program is better is we'll insure each night, each reservation. So if you have high occupancy, you use us a lot. But if you have low occupancy, you're in Martha's Vineyard, short season, you use us a little, and that's okay. And this is a dynamic that the sharing economy is bringing to the world. Is you have an asset, but you're not using it for business reasons all the time. Whereas an office is used for business all the time, and a home is used for a business none of the time. All of a sudden, we're at this place where sometimes it's business, sometimes it's not. So you need this policy that's on and off really regularly. And you also need a low deductible because our typical claim are sheets that get destroyed or a chair that gets destroyed. Like, this is bad stuff, we'll pay for it, but it's not very expensive. So it's all going to fall under your deductible if you're using this as a way to keep yourself whole during the whole rental process. So we cover the first dollar of damage, and that works for this use case.
Mhm. That's so fascinating. And I want to take the conversation in a bit more tactical direction. And maybe you can describe a little bit more about what you've learned in your time as a founder that has now raised multiple rounds of capital. And really, I would like you to allude to building products for new markets that have relatively no shape or form to them, right? Because you talk about your early trials of customer discovery, sharing your house with a guest, someone that you didn't know was a foreign concept 10 years ago. And people might have thought you were crazy if you're building products for this market that is so nascent, it's so young, nobody's really adopting yet. How did you think about building a company in sort of an ambiguous market?
Yeah, I mean, one challenge we had is we were early, and so it's hard to convince investors that this is anything more than just a niche. Like, they didn't even know that people would do short-term rentals. Now, like, why do you need insurance? Why do you need a whole ecosystem of service providers around something, short-term rentals, that I don't even believe in yet? So it was really hard to get the early traction. I think part of what helped is the opportunity was always there. I knew if we built the next thing, we get closer, and the next thing. And competitors didn't come in, the use case didn't change. So I mean, it took longer than it should have, but I could see how each step got us closer, and I knew what to do next. If I didn't know what to do next, the opportunity was no longer there. There's no way I would have kept going, but it just continued to be there. And it's like, okay, let's keep going. And once we had a little bit more money, a little bit more traction, a little bit more data, we could get to the next level. It's kind of like a massive, massive video game where you just
Yeah.
do a little bit here and then you're at the next level. And that's how it was. It wasn't like overnight. success that you read about in TechCrunch with the smartest founders in the world is this: just build a little bit more every single day.
Yeah. How did you, as a founder, address the investor concerns of the market being so young? Obviously, you probably have to have an incredible vision while you're talking to that investor about the company and where it can be. But we have a lot of founders listening to the podcast today who want insights on storytelling when talking to investors. You have to paint a picture, you have to articulate the vision. What insights can you share that worked for you early on while pitching investors who may have not seen the vision of safely.com in the first innings of the company's life cycle?
Yeah, I mean, if investors don't have a thesis around what you're doing already, it's really hard to convince them. So then it's just a numbers game. Some people do believe they stayed in vacation rentals. They bought one themselves, and they can, even if it's not their vision yet, they can see it taking place. But others, they think, oh, Airbnb is the only player in this market, which is not true. 15% of our reservations are coming from Airbnb, but the rest are coming from direct booking channels, from Verbo, from booking.com, from a variety of booking sites. And so if an investor comes in thinking that you either get a partnership with Airbnb or you don't, it's just not going to happen. It's impossible. I can explain, I can do diagrams, it doesn't work. But enough people have the thesis that, yeah, I can see how this plays out. And those are the ones you have to gravitate towards. Others might change. One thing that surprised me is that investors we end up getting, I've probably been talking to them for some time and they've said no. And then like, oh, let me look at this again. Maybe this is playing out in a way I didn't anticipate. And investors are curious people, and they'll change their mind all the time. They're dealing with fast growing trends, so like they're there. So maybe second tip is just building relationships with investors and let them see how you're doing, and then all of a sudden your data's gonna like show that maybe you were right or maybe they were right, but you found a way to address those concerns.
Mm. No, that's a unique insight there. And you're right. I mean, this is a relationship oriented business from day one. You've got to build relationships. But I think what's more important than building the relationship is cultivating the relationship over time. And that's done oftentimes through the investor updates. And that's one of my favorite ways to stay in touch with founders who may be a bit early for us, or we just didn't see the traction that we needed at that particular point in time to get the conviction to invest. And so it sounds like you can kind of double click on that as well as a founder.
Yeah, I agree. Except at the same time, I'm gonna stand up for the founders who don't send investor updates. I've been horrible at that because there's just this long list of buyers or revenue events, and so finally, I think I'm at the place where we're sending out regular investor updates again. But that is not a strength. And but I agree, it is so important. Like these people are there to support you, whether it's your own investors or external investors. Investors are very helpful people,
Mhm.
as you know. And so you want to get them excited, even if they don't invest.
Right. And Andrew, you've raised more than $10 million in funding. I know you recently raised some capital last year. Would love for you to talk about, how you raise that capital during a bear market. Obviously the highs of 2020, 2021 were no longer in 2022 really. So did you have to re-strategize, reformulate your messaging and your fundraising strategy last year? Tell us more about that.
It took some time to close the round. It actually took us a year to close the round. So we took the first bit of investment almost 2 years ago now. And that included some venture debt from a firm called Lago in Chicago. And then we closed that. They did some equity as well. And then it took a year to finally close that round. The next lead was a group called Highgate. Highgate's a large hotel operator. And we went kind of slowly because the economy was so fragile, and and hospitality companies, which is their experience, they take the brunt. Like boom economies, they do so well, but bad economies, they're just destroyed, as they just saw with COVID. So we were just kind of playing it slowly, testing the market, and eventually it worked. They changed the investment terms a little bit. They lowered the amount they put in initially, and then but then they had the option of doing a second tranche if we hit certain milestones. It looks like that second tranche is going to come through, and then we're going. So that ends up being a good investment, but it took time, and it's because of like just our industry, and then the economy, which has been rough for some
Every
time now.
Yeah,
Yeah,
it sounds like you had to
all
get
industries.
yeah, it sounds like you had to get pretty creative with your financing and how you were going to take on, venture debt, equity funding, from strategic players. Is that something that you would say played a success and getting that capital in ultimately is getting creative and sort of being flexible on how the capital is coming in and when it's coming in?
Right. Fortunately, I mean, sometimes you just do a round and it's binary. You either get it or not. So fortunately, we got the benefit of having some money so we could continue the growth and continue making those immediate investments. And then as more came in, we could make the next round of investments. So that was fortunate at least. So we weren't desperate as we went through that path. But yeah, I can't imagine there are many rounds right now that there's not a level of compromise or sacrifice or creativity these days.
Yeah. And thinking bigger picture here about safely and the broader short-term rental industry, right? We hear a lot about what's going on with Airbnb. You read the headlines, and the narrative is that their business model is collapsing, the sector is overinflated. How did we get here to this point? And in the midst of this, do you see any potential opportunities that remain for technological innovation and that allow for founders to sort of solve some of the problems and pain points that are relevant in the industry right now?
Yeah. I mean, there's been some news about Airbnb collapsing. Like their stock price hasn't reflected that. Their competitor stock price hasn't reflected that. So there's overall strength in the industry. What's happened is home supply has increased about 20% for the last couple of years, like each year. It's just insane. Like not many industries have 20% more supply join. And so what's happened is there are just more homes now. It might have been 1.4 million a year and a half ago, now 1.8 million almost homes that are on Airbnb and Verbo in the US. So with more supply, um, demand is increasing just as much. So there's still an equilibrium, but it's a shift. And so some property managers, some homeowners are taking the brunt of that. Others, it's an opportunity. But in general, the industry it was growing, more demand, more supply, but it's not evenly distributed, and so some are not faring as well. But net it's working. In terms of opportunity, I think in general everything's good. A growing industry where some people are feeling pain means there's opportunity. And what does that mean? Well, we have insurance to help some of the pain, but how about revenue management? How about all the hospitality tools that a hotel uses? Because it's a very sophisticated, mature industry. Hotels, hotel management. Well, let's let's look at best practices in hospitality, understand what's really unique about a short-term rental and Airbnb rental, and then let's bring those two together or best practices from other industries and really elevate the home rental versus the Airbnb rental or versus a hotel rental. So I think big opportunity, fast growing, fragmented industry. Um, and then the last trend that's changing as well is people are returning to normal travel trends. So
Mm.
before, when we didn't have to go to work, we could take 6 trips. Like, let's pretend you had the money to take 6 trips. You go 6 times. Like, you do your normal one summer vacation, but then you go another 5 day trip and another 5 day trip. You go to the Blue Ridge Mountains, you go to Tybee, you go to to anywhere around here, and you can work for 2 days. You're not even taking vacation time. And now people are getting a little closer to the office. The kids have to go back to school. And so we're seeing some markets hit really hard where it was really easy to go there and you could work from there. Now people are being a little bit more intentional about their travel, which means maybe they're going a little bit farther. Maybe they're flying again. So some of these drive locations are getting hit. So just return to normal.
Yeah, I think that'll be a trend that does propel a lot of innovation in the space, right? You talk about this return to normal, return to office. We're seeing traffic back at Hartsfield Jackson. I mean, it is probably surpassed COVID pre-COVID levels, I'd say. And I think that's just a key indicator right there of all the airport travel that
Yeah,
we're seeing and the delays that we're being impacted by as well. Unfortunately.
indeed, indeed.
Yeah. But, Andrew, you grew up here, you went to Emory. Why did you ultimately decide to stay here in Atlanta and build safely versus, go to the coast and build? I think that was the popular thing to do in the mid 2010s era. But, you see innovation hubs like Austin, Atlanta, Raleigh, Durham, Nashville now popping up in this region. I think Atlanta is probably leading the way there. Why has Atlanta been so special to you and safely?
So I actually launched the company in London when I was in business school at London Business School. So I was starting there. I had to get a visa if I was going to stay. I would have gotten the visa, but it's just like $3,000, and then I have to figure out that I'm going to stay. I was just getting more traction back in Atlanta because I lived here before business school. I knew people. I knew I could live affordably. I knew I could pick up side jobs more easily. Um, so I came back. My brother was helping me with the technology parts. He's now our CTO, but he was helping me with that. So it just felt like home. In hindsight, though, I wish I would have gone to Silicon Valley to start. In 2009, 10, exactly as you said,
Mhm.
that's where the early stage money was, and it wasn't here. And I mean, I don't know how it would have played out, but I think I could have gotten some of that early capital, maybe found a co-founder who, had the experience of scaling a company or things like that. I think that would have happened more easily there. We've gotten over that hump. And of course, things have changed. Things are more distributed. But now I'm loving that we're in Atlanta. We can scale the company because we can pay normal salaries and our team can have grown up lives. They don't need three roommates. Like if we were in New York or San Francisco, they can have like, you know, a regular life, maybe a little yard, a car, and, you know, parks, things like that. Like they can have a good life here, and there's plenty of talent. And so I love being in Atlanta now, but I think it, especially in that era, it did slow you. I mean, it was an early category, but I think this early stage capital for no revenue companies was more available in Silicon Valley than it was here.
Yeah. No, that's interesting. But glad you're here now.
Thank
And
you.
it sounds like the company has really found its footing in a market that was once so nascent and young, and now that is mature and has taken the globe by storm. So, Andrew, I really appreciate you coming on this afternoon and sharing insights around customer discovery, fundraising during a bear market, opportunities for innovation in the short-term rental space, how you can build products in this hospitality space. I think our listeners probably extracted a lot of insights from this dialogue today.
Thank you, William. This was great.